Welcome to the Allan Small Financial Show. As always, I want to thank all of you for taking some time out of your busy day, and I'm sure they're quite busy these days, to spend some time with us. And I know that everyone's out and about spending money in the malls and the stores, trying to get ready for the holiday season. and I always appreciate when you take some time and share with us so that we can go over what's going on in the world of business, in the world of equity markets, stock markets, bond markets. Hard to believe that we are now, I guess, December the 11th. This is our second last show for the year. Boy, has the year flown by. Together, we've tackled so many questions, so many problems, so many issues, from interest rates to the question recently of tariffs to you name it, the Federal Reserve and what they're saying, Bank of Canada actions, cut in rates, stocks going up, stocks going down. It's been a very, very eventful year, and I anticipate 2025 to be very similar. And so, what I want to do today, as we always do, is tackle a bunch of things that are going on in the economy and the markets uh, as we speak right now, and answer as many questions as I can that I've received over the last couple of weeks. So let's put up our topics for today's show. Bank of Canada announces a rate decision this morning. As many of you probably know already, Bank of Canada cut interest rates by 50 points, 50 basis points this morning. It was very much anticipated. We'll discuss that. Top three things to consider over the next 10 business days, a very popular segment of our show where I talk about three things that I think individual investors should focus on or keep an eye on before they make their investment decisions. It's that time of year for capital loss selling to offset perhaps some of the capital gains that many investors have in their portfolio right now that they will eventually have to pay tax on. So we'll talk about the capital gain loss season and what I've been going through with my investors for the last few weeks now. U.S. markets outperforming the rest of the world. Now, this has been going on, in my opinion, for quite some time. As many of you know, that many of my investors and many people in general that speak to me, you'll know that I've been investing probably a lot more, maybe as much as 5 or 10 investment ideas outside of Canada for every one inside of Canada. And many of those ideas are coming in the United States or in the United States, domiciled there. And so that is because the United States has been the biggest outperformer for quite some time now. Does it look like we're in for a Santa Claus rally? We usually see a Santa Claus rally more often than not, and that's the period of time, I guess, just before Christmas to just after New Year's. Market is usually in a very happy mood, and markets tend to go higher. Do I think we're getting in for another Santa Claus rally? I'll talk about that. Thought I would do a look back, looking back at 2024, look ahead into 2025. What I see, what are the outstanding, or at least the main topics for discussion heading into 2025, at least on the onset. Obviously, things will change throughout the year, but what are we focused on heading into 2025? Quick hits, three things that you may see on the news, social media. Want to touch on those very quickly as well. And lastly, your questions. Always like to get to at least one question, if not two, before we sign off. And anyone who has any questions, please put them in the chat boxes. Love to get to them at the end of the show. If not, I will address them over the next 2 weeks before our last show for the year. Hard to believe, our last show coming up. And if not, I may address them on our final show of the year. So without further ado, let's move forward with the show. So the Bank of Canada this morning announced a rate decision, a rate cut of 50 basis points. And it was pretty much telegraphed that they would go 50 basis points. I was hoping for just 25, but of course I don't have much influence on the Bank of Canada. But overall, they thought 50 basis points was the better way to go. And not sure that this is the better way. Obviously, we went through in 2022 a series of about 10 rate increases. Now in 2024, these have been followed by 4 or 5 rate decreases just as fast as rates were increased, we're seeing the rates decreased. And in my opinion, I just don't think these rate movements, interest rate movements, really have enough. We haven't given them enough time to affect the economy so that we could see, the Bank of Canada could see the effects of these rate movements. And that's my fear. We raised rates so fast. Now we're cutting rates so fast. Begs the question, should we have raised as much as we did? And I just don't want to be around 6 months from now talking about, well, maybe we cut too fast and inflation is going higher and now we have to raise again. So that's the worry that I have. And it's something that I understand the Bank of Canada is doing their best. There's a lot of moving parts, which we'll discuss in a moment. And it definitely makes the job of the head of the Bank of Canada, Tiff Macklem, it makes his job very, very difficult. Our first chart here shows the Bank of Canada key interest rate versus inflation. And you will see that our key interest rate now, Bank of Canada rate is now 3.25%, down from 3.75%. Inflation rate, our most recent reading of inflation in Canada is 2%, right at target. So we still have a little bit of room there, a little bit of room to cut rates if we need to, if the Bank of Canada needs to. But again, I'd be a little bit cautious in continuing to cut rates as aggressively as they have. What does the rate cut do of such a magnitude? And telegraphing those rate cuts in advance, what does that do to our dollar? Our next chart here, I've shown it before, show it again, how much our dollar has gone down versus the US dollar. That number actually is 70.71 cents now when we came on the air. I thought that the 50 basis point cut would have a more of a negative effect, to be honest, on the currency rate versus the US currency, but it didn't really. In fact, Canadian dollar actually went up versus the US. But I think that if the US cuts a quarter point next week and then takes a bit of a pause, and if the Bank of Canada would continue to cut rates in the new year, perhaps we see for the first time in many years our dollar fall below 70 cents versus the US dollar. So got to keep that in mind, and I think the Bank of Canada will have to keep that in mind as well. Our next chart here shows the unemployment rate. Unemployment rate in Canada ticked higher to 6.8%, up from 6.5%. Highest reading that we've seen in unemployment in quite a while. Even though we grew 51,000 jobs in the month of November, still didn't help keep our unemployment rate down. We obviously saw or had a number of people looking for jobs, number of people filing for unemployment insurance. And we're seeing this rate, as you can see here in the chart, tick up so slightly. And in my opinion, this was the number one factor for why the Bank of Canada, instead of cutting a quarter point, cut 50 basis points. You couple this higher unemployment rate with GDP growth of just 1%, and which is obviously very low. You look at that on a per capita basis, it's the worst in all the G7 nations. And no wonder why Bank of Canada continues to try and stimulate. Now, Bank of Canada did say, Tiff Macklem did say this morning that he believes future interest rate movements will be more subtle, won't be as grand or as big. So maybe they cut again the next meeting in January, but they're talking about now maybe only a quarter point at most. And obviously the economic data will be the factor to decide whether they cut or not. So we'll have to see how these cuts take effect with respect to our currency, with respect to real estate. As we know, one of the biggest factors on real estate are interest rates. And we know that the housing market's starting to heat up in the GTA a little bit. And many believe, including myself, that we will see a very hot buying and selling season in the spring because of interest rates coming down. So good news for everybody, I guess, who is borrowing money, lines of credit, variable rate mortgages. We expect prime rate to come down to about 5.45%. That will help. That will help a lot of people that have debt bring down those interest payments. But all those that are on fixed rates, those actually will not come down. And so you have to be very careful what you do if you're renewing a mortgage going forward, whether you want to go fixed or variable. I think you need to speak to someone about that and decide whether you think rates are going to come down further. Maybe you go variable. And if you don't, then maybe you go or you lock your rate in. But overall, it looks like the Bank of Canada has cut 50 basis points this morning. They will continue to look at cutting or easing more in the new year, but at a much slower pace. Now we come to the part of the show that I actually get most feedback on. And it's the part of the show where I talk about three things that I think individual investors need to focus on before they make their investment decisions. And you can see our three things here today. Fed rate decision next Wednesday. Yes, we had our rate decision today, but as I say quite often, what the Fed does affects our markets here in Canada and the US markets far more than what the Bank of Canada does, unfortunately, or perhaps fortunately. There's going to be a lot of data that we've already received and some more data coming out between now and next week so that the Fed can make the best decision possible. We'll touch on that. Expectations too high. Have expectations gone a lot higher, perhaps too high for many companies that they just can't live up to those expectations. When they report earnings, it's just not good enough. Investors seem to want to sell the stock. We'll talk about that. Take emotion out of investing. I can't tell you how many conversations I've had recently where investors are saying, you know what, Allan, why do we own this stock? It's not really doing much right now. Yeah, it's paying a good dividend, but why don't we get into something more sexier, something that is moving quicker, something that, that I think we're going to have gains quicker. Emotionally, they're trying to chase what's going on out there. And I just don't think that's a recipe for success. So we'll talk about taking the emotion out of investing, because I think a lot of investors right now are putting a lot of emotion into what they're investing in. So let's get to our first topic, the Fed rate decision. And as I said, they'll have a Fed meeting next week. And it's still anticipated that they will lower the rate by 25 basis points, even though most of the economic data that we have been receiving, we just received CPI data in the US this week. We're going to get, actually today, we're going to get PPI, which is the producer price index, which are your wholesale prices. We'll get that or look at that number tomorrow. But the consumer price index, a measure of inflation for the consumer, how much they're paying. It is a little bit skewed more towards real estate than the PCE, which is the personal consumption and expenditures. Another favorite for the Fed to look at regarding inflation. But CPI definitely gives us a look into what's going on with inflation, and we had that number today. Before we get to that number, however, let's take a look at our target range for the federal funds rate. We have a chart here which is showing that, yes, the Fed funds rate is coming down, 4.5% right now. We're expecting another quarter basis point. That would take us to 4.25. Coincidentally, that would be exactly 1 percentage point higher than the Bank of Canada rate. And at what point does that discrepancy or that gap between the two start to affect things? We're already seeing it affecting our currency, but when does it start to affect trading between the two countries? Exporting, importing, when do those things start to become affected? I'm going to say right about now, in my opinion, I think those things are being affected. But as I said, there's a lot of data. A lot of data has come out already. GDP, our next chart, shows you 2.8% was the GDP reading for Q3. I've heard that Q4, quarter number 4 for 2024, is actually trending even higher, above 3%. I heard as much as 3.2% for the fourth quarter. To me, that would be just a blowout number, a number that, I think if anybody would have anticipated that, you probably would have said, no, there's just no way with interest rates in restrictive territory in the US. How could they possibly have GDP above 3%, between 3.5%? Well, it looks like that is what's going to happen. And again, these are the types of data points that keep the Fed from saying, we have to cut quicker. They don't. The economy is doing extremely well right now. How do we know as well? Let's take a look at the jobs chart out of the US. Jobs, 227,000 jobs created for the month of November. Again, very strong number. Don't compare that to the October number. That was a little skewed because we had the hurricanes and a few other things, a few strikes going on. But compare that to the September number, it's just below it. So just under. Again, falling in within the range of expectation, both on jobs and actually CPI. CPI we'll get to right now. You can look at the number here. Consumer Price Index, 2.7%. Ticked a little bit higher. But the core reading, which takes out food and energy, stayed at 3.3%. So again, as expected. And maybe that's why the markets took that in a positive manner this morning when CPI came out and it was expected. Perhaps that's why the market did not go down. In fact, it actually moved higher before the market opened this morning. And last I checked, NASDAQ was up significantly. Dow Jones was kind of flatlining, S&P up a little bit. But overall, I think that these data points are going to be huge. And we're also going to get retail sales, where, as I said, PPI tomorrow, which is wholesale prices. So we still have some data points to come before the Fed makes their decision next week. And as I said, right now, the odds are 25 basis points. If they don't go 25 basis points, if they stay as is, I think that's going to have a pretty negative impact on our dollar going forward. And we could see our dollar fall below 70 cents perhaps. So hopefully they go a quarter point. I think the market has it factored in. If they don't, I think the market will pull back. But definitely something to keep an eye on before you make your investment decisions. The next topic I wanted to get to, expectations too high. And what do I mean by that? Well, I just think that the market is pricing in these really lofty expectations, especially in tech. And I think pretty soon they may take these lofty expectations to other sectors like bank, because right now you're seeing some really blowout numbers in technology land. Oracle, which we have a chart on, which we can show here, they were a stock or a company that just reported earnings yesterday. And I thought their numbers were good. Yeah, they may have slightly missed on the expectation, but they grew their AI infrastructure business 52% year over year. Unbelievable. And yet the stock, as you can see it here, this is a number from yesterday, dropped almost 7%. So what kind of expectation was built into the Oracle numbers? We also had another AI company report yesterday, and it was C3 AI to be exact. They're another infrastructure or AI play, and we don't have a chart on that, but they reported blowout numbers. The stock is up over 100% since September alone. But because they were up so much coming into their earnings, stock market said, oh, well, it was expected that they were going to have blowout numbers. Stock actually went down initially, then it went higher late in the day. But it was unbelievable to see the stock open up lower with such just amazing numbers coming out of their AI investments and their AI part of their business. Another stock that we do have a chart on, which is AMD. And we've seen this company report what I think is great earnings. They came into this year saying they're going to make $2 billion in AI. Now they're up to $5 billion, $5.5 billion in AI, in that range right now. And yet the market went from about $225 a share on AMD to now sitting at under $130 a share. Unbelievable how much the market has sold off AMD stock, even though AMD business is just going through the roof. They can't keep up with the demand for their chips. NVIDIA, the biggest chip maker in the world, the biggest chip company, the biggest company in the world, them and Apple are neck and neck for the biggest market cap. And we've seen their stock pull back after they report earnings. They grew their recent earnings 94%. Everybody would be totally excited. Yeah. We would be very excited if a business grew by 94%. But because they grew 116% the quarter before and over 200% the quarter before that, people sold the stock. Investors sold the stock. So again, high expectations, very lofty expectations. This is what these tech companies have to deal with. And as I said, if you are a company in another sector that has done well and we've seen your stock rise, yeah, your expectations will be ratcheted higher and that bar will continue to go up. And to me, this is a bit of a worry. And I think individual investors need to keep an eye on this, because if you're buying into a company that has lofty expectations, well, I think you got to be a little bit careful, because if they don't meet expectations, possibility for a larger than expected sell-off is there. So keep an eye on expectations. The third point I wanted to make to individual investors before you make your investment decisions is this idea of taking emotion out of investing. And whenever you talk about emotion and investing, you have to show the investment emotional cycle. Very popular illustration, which we have here. There it is. And you can see all the different emotions from the cycle here. It's still early days, I'll keep my eye on the market, to good thing I didn't wait any longer. Point of maximum risk, people don't realize, is when the market is at a top. Now, markets are at all-time highs right now. Does that mean they're at a point of maximum risk right now? Well, I think it just depends on what type of investments you own within the market, but that's what the cycle of emotion says. And you can see here, point of maximum fear is probably the best time to get into the market. So there's your cycle of emotions. And what I'm getting right now is a lot of this type of FOMO, right? Fear of missing out. I get a lot of investors calling me up and saying, you know what, Allan, my investment that I have right now in, let's take TD Bank. We have a chart on TD Bank. I've had a number of people call me up and say, why do we own TD Bank? It looks like stock's not going to do anything. A lot of people are saying it's sort of dead money right now, even though it pays a 5.5% dividend, which is fantastic. If I could just sit in money and not have it go up or down, you could use that 5.5% as a GIC or bond replacement. You know, I don't think there's any worry that TD is not going to make their dividend payments. In fact, they just increased their dividend this past quarter. So you're looking at a name like TD or something else that hasn't moved, and I'm getting a lot of questions. Should we sell it? Should I go out and buy a tech name, something that is moving a lot quicker? And my answer is no. I think you got to stay disciplined. You got to stay with these good quality names. And I think TD Bank is a good quality name. May not be moving a whole lot right now. We just had a bit of a negative report from TD this past quarter. And we know that it's gone through a lot of issues regarding money laundering issues. So we know TD is in the doghouse right now. How quickly it will be in that dog, or how soon it will get out of the doghouse, remains to be seen. But if you pull up that chart just quickly once again, we could see that TD has started to move higher in the last couple of days. If you pull up, there it is. So everybody who's called me in the last few days saying, let's sell TD, you would have missed out on probably 3 to 5% growth just in the last few days. So you can't leave good quality names just because they seem to be struggling right now to find something that has already moved higher. You want to buy low, sell high. You don't want to buy high to sell low. So for me, taking that emotion out of investing, trying to chase the hot investment, that FOMO, fear of missing out, you got to really fight your instincts or fight that feeling of doing that. And to me, that is quite important. So keeping things real, keeping the emotion out of investing, I think is extremely important. Also, keeping an eye on the Fed, what they're going to do over the next, I guess, their next Fed meeting or the next week or so, and then expectations. You want to own a stock that has high expectations? I think you have to be mindful of that as well. So those are the three things that I think individual investors should focus on at this time before you make your investment decisions. Many would say it's holiday season. Others would say it's the winter season's about to start. Well, in my world, it's the capital gain loss season. It's the time when I sit back, go through as many portfolios as I can, as all of them, and if I can get to all of them, and I don't get around to all of them because not everybody has a capital gain that we need to be concerned about. But there are many that have capital gains that I try to offset with capital losses. Now, let's understand what's happening. Whenever you buy an investment and that investment goes up, when you go to sell it, you will have a gain, and you have to pay tax on that gains. And obviously, for most of us, it'll be still 50% of that gain is taxable, 50% you don't have to pay tax on, and the 50% you pay tax, you will pay at your marginal tax rate. For others, for corporations or trust accounts, that could be as much as 67% if that inclusion rate gets raised. They voted on it. It looks like it passed, but I don't think that inclusion rate has settled, meaning I don't think it's gone through the proper channels in government yet, but it probably will by the time we go to file our tax return. So for the most part, for those of us that have less capital gains than 250,000, which are pretty much the majority of us, we're going to pay 50% of those gains at your marginal tax rate as tax. What can lower those capital gains? Capital losses. So if you have a position in your portfolio, non-registered account, and you were to sell it for a capital loss, that would offset and go against or be subtracted from your capital gain. So that's what I do right now. I look at portfolios and I try to figure out where the capital losses are and do I want to sell that investment? Because remember, when I'm selling it, investors losing money. So I guess the first question is, when do you sell an investment for a capital loss versus not take the loss and continue to own it? Well, my opinion, I think two things. One, if it's an investment that you believe probably won't come back or start moving higher again for a long time. Keep in mind, whenever you realize a capital loss, in order for you to write it off against your gains, you cannot buy back that same investment for a period of 30 days. So when you sell something and you believe that, okay, that investment's probably not going to go higher for the next 30 days, it's probably going to stay where it is, I think that's the time when you can take a loss on that investment, and then you have the opportunity in 30 days to buy it back. The other time I think you sell an investment is when you think that investment no longer fits the profile of the investor, or you think the investment itself, the thesis of owning it, is no longer valid, that you think that investment, I should say, is not worth owning again, has a loss, you sell it, it offsets against the capital gain. So that's the strategy with respect to capital gain loss selling season. But what I've been finding for many investors of mine, and what I imagine people are finding for many investors as well, many of their investors as well, is the idea that there really isn't much in the way of capital gains right now. Sorry, capital losses right now for individual investors. We're finding that all I seem to see is capital gains. Our first chart here will show this. We show all the different sectors of the S&P 500. And as you look year to date, all you see is green. Even the 3-month, you have a couple of red numbers, but for the most part, every sector is positive. So where are you going to find capital losses to offset capital gains? There aren't any, or there aren't many. Yes, there may be one or two here and there, but it's been very difficult to lower that capital gain that an investor has this year. Now, don't get me wrong, it's a great problem to have. It just means that everybody's making money. There are no losses, all gains. But of course, living in Canada, you're going to have to pay some tax on those gains. And that's what I've been finding with respect to capital gain losses this year, that investors, especially if they've taken money out this past year for whatever reason, to fix up your home, to go on a vacation, whatever the reasons may be, you're going to have a capital gain. And unfortunately, if it's a fairly large one, probably isn't much we can do with respect to capital losses. But again, keep in mind, my mom always said, if you have gains or if you're making money and you're paying taxes, that's a good thing. Don't be worried about the taxes. It just means that as an investor or as a person in general, you're making money. So overall, capital gain loss season, in my opinion, for me, it's going to go on for another week and a half until we come right up to the holidays. Be looking for any way to lower capital gains for investors. And if all of you listening or watching today, I think you should be doing the same as well. US markets have definitely outperformed the rest of the world. And I would say, the exception of this year, because I know TSX actually is close to the S&P in terms of gains for the year, but prior to this year, for quite some time. And as I said off the top of the show, I've been investing individual investors' money in the US now for quite some time, or I should say in the US and globally, so outside of Canada. For every one investment, I started off maybe with 3 to 5 outside of Canada. Now it's probably closer to 10 or maybe even more. And I think it's a function of a couple of things. Number one, obviously the outperformance by the US markets, but also the fact that our market here in Canada is small. We have just over 200 stocks on the TSX, or the Toronto Stock Exchange, whereas in the US, you have many, many more stocks. In Canada or in Toronto Stock Exchange is made up of predominantly 3 sectors, one being banking, 2 is your oil, and 3 your materials or gold stocks. And for many investors, they don't like the risk that oil and gold present, tend to be on the higher risk side of the scale. And so that only leaves them with maybe banking and the other 25%, which is made up of a couple of railways, maybe, Loblaws, a company like that, Shopify, which is our largest tech name. So there are some names that you could take a look at, Dollarama, for example. But for the most part, you're looking at three sectors that dominate. And that's, again, a big reason why you want to go outside of Canada. And many mutual funds, Canadian mutual funds, have as much as 45, 49% invested outside of Canada. Can't go more than that because to be considered a Canadian mutual fund, you need to have at least 51% invested in Canada. So even Canadian mutual funds or anything Canadian managed product to stay Canadian, you need to have at least 51%. But many of these investments have the other 45, 48% invested abroad. So US outperforming a lot of other parts of the world. Our first chart here shows the US equities, their dominance and the value of versus the value of global stocks. So you can see here, US equities dominate the value of global stocks. How much of the global stock market is US? 67%. Wow, that's a massive number. Look at the next highest one. You're looking at 5% Japan. You have other at 20%. Now that makes up obviously many countries. Canada makes up 3% of the world's stocks. Even China only makes 3%. So it is interesting to see how much the US equities or US stocks dominate in the world. And I have to believe that number has gone up tremendously just in the last few years with the dominating tech stocks that United States has. Microsoft, Amazon, Meta, formerly Facebook, Alphabet, formerly Google, NVIDIA, AMD. These are Micron. These are massive companies. A lot of them in the tech, all of them in the tech space. I shouldn't have forgotten Tesla, right? We call these top seven or the seven largest, the Mag 7. Tesla, another $1 trillion company. So I think that these stocks have really caused that number to balloon to 67% over the past few years. Our next chart that we have here is a chart on US stocks consistently outperforming global ones. And you can see here, maybe with the exception of 2022, when the United States raised interest rates 10, 11 times, yes, the global markets or global stocks outperformed by just a hair. But if you look at the orange bar there, you could see the dominance of the US market versus the global ones. Take a look at 2024. You're looking at 28% gain. As I said, the TSX is also in that 25-ish% range. So not dominating the TSX as much, but if you look at Europe and other areas around the world, Asia, you see, for example, China is struggling with growth. Their exports were down. Their imports were down recently. So China is definitely struggling. Anybody doing business in China, whether you're Apple, whether you're Starbucks, whether you're a chip maker, anybody, you're seeing softening. Nike, you're seeing softening coming out of China. And China, as we know, makes up a very large percentage of the Asian market. So definitely, we continue to see dominance in the United States. And that is why I continue to put my clients' money in the United States. Now, one last thing I will touch on is that a lot of people are going to tell me, Allan, but I only have Canadian dollars to buy. How do I buy US stock, for example, with Canadian dollars? I'm going to lose almost 30% to currency. Well, you are correct. Right now, the Canadian dollar is very weak. To buy US stock or US dollars, it's probably not worth it. Well, I will say that I continue to buy US stock. And the reason is because, yes, you may lose to currency when you buy, but as long as that currency remains plus or minus a few percent within that range of when you bought, when you sell, hopefully the stock goes up. You make 20, 25% on the stock, let's say 15, 20%, whatever it is. And if you lose maybe a couple of percent due to currency, I still think it's worth it. So I don't think you need to be fearful that the Canadian dollar is going to rise significantly. You just want it to stay within a range of a few percent of when you bought the US dollars to when you sold that stock and converted it back to Canadian. If you can have a stable dollar, that is what we want. Over the last couple of years, Actually, it's worked in my favor or my investors' favor or anyone's favor that has taken Canadian dollars to buy US because the Canadian dollar is weakened. So your US investments have gone up. And when you take it back into Canadian dollars, you definitely would have another gain there. So not only did you make money in the markets this year, but you also, if you owned US, you would have made money on the currency trade as well. So double positive. So overall, I still believe the US is the best place to invest right now. It is a dominating market. It is the largest market in the world. Roughly 20% of the world's wealth flows through its borders every single day. And it's a market that I think you need to continue to be in if you want to see growth in your portfolio. So does it look like we're in for a Santa Claus rally? I love that visual there. You have Santa riding his sleigh with the reindeer going up, up, and up. And it's interesting because more often than not, we do see a Santa Claus rally. More often than not, the months of November, December, and January are positive for the stock market. Actually, it's the best 3 months of the year for returns. And if you add in October, which we know comes in a little weak from September, and the second half usually is pretty strong, you want to add October in there, it's a pretty good time to be an investor. Our one chart for this segment is or clearly shows the S&P December returns for the last, look like 53 years or so. You can see how many times December was red. And I guess it looks like, I'm just doing quick math here, December 22nd was the last time, as we know, because of higher interest rates. Prior to that, December 18th, I think, was the last time. But look how many years we saw green numbers. And anticipation is December for 24 will be the same. Now, what I'm going to tell you actually this year is maybe slightly different than what you may expect and what perhaps these numbers tell us. I'm going to tell you, because 2024 was so strong of a year, I believe that the market basically took from future gains and brought them forward to November. So what I mean by that is, I think the gains that normally you would have had at the end of the year, we had them earlier this year, November, October, even September was a slightly positive month. So I think the market brought forward those gains a little sooner than perhaps you normally would have seen them based on various reasons, interest rates, Fed speak, you name it, really good earnings from businesses. So I actually believe that Santa Claus rally will be somewhat muted. If we can get maybe a 1 to 3% gain out for the period, maybe 1-2% at most, I'd be happy with that. If we see a positive December, I'd be happy with that, because that would allow all of us to consolidate the gains that we've had for the previous 11 months. I don't want to see a negative month. I want to see a positive month. I just don't believe that we're going to see the big Santa Claus rally that perhaps we've seen in the past, or that maybe some are expecting. And that's because, not because I think or I'm sour on the markets, I just think that we've borrowed or taken those gains earlier this year, borrowed from future gains this year, earlier in the year than we normally would have done. So for me, I still believe that we will have a positive December. So anyone who's watching, I'm not saying to sell your investments, that markets are going down, by no means. All I'm saying is, I think the returns are going to be a little bit more muted than perhaps other years that we've seen gains in December. So I thought it'd be good to, really good to take a look at the year that was 2024 briefly and give a bit of a look ahead for 2025. And, I think 2024 was very similar to 2023. I've said that already on our show earlier this year. Our first chart will show this, the S&P 500. You can take a look at really the steepness of the chart here. You can see that maybe 2024 was a little bit steeper than 2023, but both of them go from the bottom left to the top right in a very nice fashion. And Overall, it's been a good year for most investors. I would probably say almost all investors have gains of some sort, depending on what investments you're in. That would dictate the amount of gains, but I would imagine it's been a good investing year for many. And our next chart here of the QQQ, Invesco QQQ, shows us that it was another great year for tech. Tech had a few ups and downs. Let's call it in August, I guess the time period of somewhere around September, August, another one earlier in the year in April. But for the most part, again, from the bottom left to the top right. So the market was led by technology. There is no doubt about that. However, what was different in 24 from 23 was that when we hit the midway point of this year, we started to get interest rate decreases. So what did that do? Well, it started to get the market very excited, and other sectors started to participate. What other sector? Banking. Banking was one of the top performing sectors for 2024. And we have a chart for that, the Hamilton Enhanced Canadian Bank Index, or ETF. There it is. And you can see from the time of roughly summer, August, this banking sector really, really started to take off. And so that has been really what 2024 has been about. It's been about lowering interest rates, technology, but more of a broadening out of the market gains. What do I anticipate for 2025? Well, at least to start initially, I think the headlines that will affect markets are, number one, tariffs, right? Tariffs that are being or spoken about by the president-elect. Former President Donald Trump has threatened 25% tariffs on goods, all goods coming in from Canada, from Mexico, and maybe even an increase of 10% on China. Geopolitical events, what's going on in the Middle East, definitely can have an impact on the stock market. What's going on in Russia, Ukraine, and China, with Taiwan, all of that will definitely have an effect. Interest rates, what the Fed does, what the Fed says, what all the Fed governors say, that too will have a very large impact on the stock market in 2025. And last but definitely not least, more on a micro level, valuations, businesses, corporations. We talked about it earlier, that high bar, high expectation. Businesses are seeing their valuations stretched. They're expensive, trading at a premium. Should we be looking at buying stock that is expensive? Obviously, the answer is no. The illustration we have here on Trump tariffs, he's proposing a significant increase in tariffs. You look at what he did when he was in office last time, tariffs on about 14% of imports from Canada, and or 14% on imports. And now you're looking at would affect all imports. So that illustration clearly shows how much more tariffs will impact not only Canada, but also the US as well. The second diagram or chart that we have here is Canadian exports to the US would nearly flatline under Trump's tariffs. That is the forecast. The baseline is for the green line, and the 10% tariff on all exports is the dotted line there. So you could see that it would be, or it would affect tariffs, how they would affect the the business that is done between Canada and the United States. Just recently, I think yesterday or this morning, I heard that the Prime Minister has threatened our own tariffs on the United States, or at least to retaliate in some capacity if the US puts 25% tariffs on all our goods to them. So we'll have to see how this plays out in the next week or two and into the new year. Geopolitical events, these are definitely something to keep an eye on. What's going on in the Middle East? Obviously, the downfall of the Syrian government, the Assad regime. Now we have a new government forming in Syria. How's that going to play out? Still, we have the Hamas-Israel war still rages on. There's I guess a ceasefire with Hezbollah for now. We have still fighting in Ukraine with between Ukraine and Russia. What China is doing with respect to Taiwan, we every now and again hear some things there. So definitely keep an eye on all of those. Interest rates. We talked about interest rates early on in the show. If the Fed does not cut interest rates in the new year, I guess too much, how will that impact the stock market? I think it'll make things a little bit more difficult. If they're more accommodating, obviously better for the stock market. And last, as I said earlier, but not least, valuation. I think valuation is something I talk about all the time. We have a chart on the S&P 500. We can see how much valuation has gone up in the last, well, let's call it just in the last 6 months. Look at valuation. Wow. S&P 500 PE ratio. Look how much that has gone up. So again, do you want to buy stocks that are at a premium, or do you want to buy things that are of good value? And make no mistake, there are always good value names out there. I'm not going to tell you that just because the general market is expensive that, not to want to invest your money. I think there are some tech stocks that are still cheap. Google, Meta, I still think very cheap. I think there are still bank stocks that work that are cheap. I think TD Bank, we mentioned it earlier in the show, is cheap. We want to look at a sector that has been quite cheap and left out of the market rally this year. Let's take a look at pharmaceuticals in the US. We have a chart on that. Look at the pharmaceutical chart here. It has not participated. In fact, recently it's gone down. It's gone down with the appointment the putting forth the name of Robert Kennedy Jr. As the head of the HHS, head of the Health and Food Services for the United States. And pharmaceutical companies did not like that much. And the stock many stocks have sold off. So maybe pharma, whether it's biotech or Regeneron or Pfizer, these names have been beaten up quite a bit. Even Eli Lilly, a high flyer over the last couple of years. We've seen their stock fall recently as well. We had Eli Lilly on a previous show. So again, you want to be mindful of what's going on out there. You want to take a look at the things that can affect the markets in 2025, whether it's valuations, whether it's tariffs, whether it's interest rates, geopolitical events. These are the things that are going to dominate, in my opinion, the headlines going into 2025. But who knows, right? First couple of months, things could change. Halfway through the year, things could change. And I'm quite certain that coming out of 2025, a year from now, we possibly will be talking about something else. So that's my look back and look ahead into 2025. Quick hits. These are 3 things that have popped up on my radar that has been in the news recently. TikTok, talking about U.S. ban on TikTok could happen in the month of January. How much of an effect it's going to have on individuals in the U.S., small businesses, creators. You can see here 1.3 billion in just 1 month. Nvidia shares, they fell recently. Why? Because China opened up an antitrust investigation against them. Now, many people believe that this was just cloud, fluff, whatever you want to call it, that NVIDIA is way too important to China in terms of providing chips to their businesses, to the government, to put an antitrust or some sort of penalty on NVIDIA. So a lot of people think that this is just China trying to fight back against all the restrictions that the United States is putting on. And third, fast food industry watchers expect big discounts in the first half of 2025. Fast food chains cutting their prices on their food. It's good to see for those that are frequently going to fast food restaurants. I don't go too often, but I know many people do. So let's get to the first one quickly. TikTok, a ban on TikTok. What does that mean? Well, first chart will show it all. Ban on TikTok. You can see here how many quarterly users from 2018 to 2024. Look how much that number has grown. So if the US were to ban TikTok, Canada follows suit as well. How many people would lose, as I said, 1.3 billion in just 1 month? You're going to talk about businesses losing the way that they advertise, that they get information out. Individuals go to TikTok for their news to see what's going on in the world. So many people use TikTok. And, I understand the United States believes that this is a way that China can infiltrate the U.S., can have an effect on U.S. voters, U.S. people in general, what they like, what they think, what they believe. I don't know if I'm in total agreement with that, but if the U.S. were to ban TikTok come January, and I know that right now TikTok is trying to appeal this. They've already lost recently an appeal in court, but they keep going, trying to do what they can to stay in the US. It's quite important for TikTok, obviously, and for many people. The second topic that we wanted to get to quickly on a quick hit is NVIDIA. NVIDIA, largest company in the world, largest chip maker in the world, worth, last time I checked, somewhere around $3.5 trillion. And NVIDIA, as I said, there was an antitrust investigation opened up in China against NVIDIA, and that took down their stock slightly. But I think cooler heads have prevailed for investors. And so we've seen NVIDIA stock just as early as this morning move higher again. So I don't think that any antitrust investigation will have a long-lasting effect on NVIDIA. I think people are going to buy the stock if they believe that their chips will dominate for, well, going forward, at least for the foreseeable future. They will definitely have some competition in the future. Google has a new chip that they just announced, AMD, and many others will follow. But for now, NVIDIA has such a dominating position, and we have a chart on NVIDIA. You could show it here. There it is. They have such a dominating position right now with the chips, AI chips, that it's going to take a while for anyone to catch up. But you can see that NVIDIA has even flatlined towards the right-hand side of that chart and has no longer gone up with the same pace that they used to move higher with. The last quick hit that I've seen in the news is this idea that fast food restaurants are going to start to discount or cut prices. Why is that? Well, they've seen a lot of people leave their stores, their locations. They're not going in right now. They're saying that even fast food has gotten too pricey for individual. I guess when government was giving out money during COVID and other times, and when they were able to set aside that money and spend it once everything reopened, they had money to pay these higher prices. But because inflation has made things a lot more expensive, these fast food restaurants have noticed that they're starting to see less people coming into their establishments, and they're going to cut prices to try and lure people back in. Just a pretty neat chart here. Top 10 restaurants in America by sales. Thought it would be good to show. McDonald's, by far, the number one. I'm sure that's not a surprise. Starbucks, I'm sure that's not a surprise either. Number two, if you walk around Manhattan, New York, all you see is Starbucks or McDonald's. But I think Chick-fil-A, I know my son likes Chick-fil-A. I think Yorkdale Mall here in Toronto has a Chick-fil-A. 21.6 billion. I'm surprised to see that as number three. But you can see here, Taco Bell, Wendy's, Dunkin', and Domino's, I guess, rounds out the top 10. So look for some discounts at some of these fast food restaurants in 2025. Perhaps that will work to get people back into the fast food chains. And if you're a fast food eater, I guess you're going to be happy to see that in 2025. What's my take? Well, this is the part of the show where I answer at least one question, and I always like to get to at least one. I know the show went on a little longer, a lot of information today. So let's see what we have here. Here's a good one. It goes with the theme of our show a little bit. On Friday, Statistics Canada announced Canada's unemployment rate had risen to 6.8%. What impact do you think this has on recent policies? And you look at that with immigration, looks like it's going down. What impact will that have on the economy in 2025? So we touched on that a little bit. I think that with an unemployment rate going up to 6.8%, that really was the nail in the coffin, as we say, for a 50 basis point cut by the Bank of Canada today. I think with immigration slowing down, I think that coupled with a weaker dollar, which is happening because, again, we're lowering interest rates, perhaps we start to see inflation poke its head higher once again in 2025. I think the Bank of Canada is going to be mindful of that as they set interest rate policy going forward. So with that, I want to thank everybody tuned into the show today. I hope we were able to give you some knowledge, some information that you could take away from the show. I look forward to seeing everybody back in 2 weeks for our final show for 2024 on Wednesday, December the 25th, Christmas Day. Yes, we will be broadcasting Christmas Day. So after you open your presents under the tree, turn on the computer and watch our show, and we'll talk about, again, the year that was, the year that will be, and many other things. Top 3 things to look at before you make your investment decisions moving into 2025. So with that, I want to say thank you again for watching the show. And until we see you again, happy investing.